Dividend investing is one of the easiest ways to get started with investing, with building your net worth, because all you really do is you just find some money, you earn money, whatever it may be, you have money, you invest it in stocks. It's a very quick transaction. It's very liquid. Granted, for dividend investing, you definitely want a long-term outlook, but it is something easier to do to get started versus real estate, which definitely takes a little bit more of a learning curve. So when it comes to creating your dividend portfolio, though, it's not just picking a stock and hoping you get lucky with it. There is a little more that goes into creating the portfolio that is perfect for you. That's what we're going to talk about in this video. And if you guys are new to the channel, I do a lot of dividend investing stuff. I also share some insights on how you can grow your business. So if you are new here, definitely hit subscribe, notifications bell if you guys enjoyed this video. So anyway, when it comes to dividend investing and creating that perfect portfolio, it's very important for us to think about what is a perfect portfolio for us, because someone's portfolio that is perfect for them may not necessarily be perfect for you. What I mean by that is that people have different ambitions in investing based on where their age is. You typically see younger people invest in these higher risk companies, and you see older people do a lot more bonds usually, because they are a lot more focused on just, having a consistent income coming in, especially if they are retired and they live off of that income. Dividend investing can lead to that awesome ability where you are making more income from the dividends alone than your living expenses. In fact, I wrote a book about this recently, which I will be adding it to this here once I actually have that paperback in my possession. But my new book does definitely hit on some of that. So when it comes to creating that dividend portfolio, we've talked about how people have different goals, but you want to get clear on what your goals are. Do you want to build up for 10 years or 20 years so your dividend income can pay off all your living expenses and you don't have to work at a job? It's entirely optional for you at this point. Is that what you want? Or do you want to make some higher risk plays that could pay off very nicely? You see some stocks, they double, they triple in a year. It's definitely an outlier, but it is possible. But at the same time, while you can get this big payoff, you could also get hurt a lot if things don't go your way. So that's the most important thing, figuring out what you want as an investor, what your goals are, and then you create a portfolio around that. So for me, I'd rather be in the point where I'm really young, so relative to when people start investing. I started investing at, I want to say around 19 years old or maybe 20 years old when I first started investing. And if I just invest in dividend stocks and they continue to grow, and I have a lot more time before I turn 65, which is, that big number people say about retirement, stuff like that. But I have more time to just let that money sit and accumulate. So for me, my goals as an investor are, let me build up the dividend income every year, get to a point where I don't have to do anything. Like, I love doing videos on YouTube. I love podcasting. I love doing all the things I have to do. But if I had to take a year off due to some family emergency, because I've seen this play out, if you have to take a year off from for family emergency or whatever it is, or you just want to go on more vacations, you have that flexibility and you can adjust. So the dividends allow me to prepare for something like that should it happen. And it allows me to, just gives you more options. Money is something that gives you more options. The more money you have, the more places you can go around the world. The more real estate you can buy, the more dividend stocks you could buy. More money gives you more options. So think about what you want to do. Now it comes to the actual picking stocks. And when it comes to dividend stocks, there are a few criteria that are really important. The first one is sector. Now, you don't want to invest all in on one sector, because then you're not as diversified. If something really big happens in your sector, it's going to influence your portfolio. If something really good happens, that's great. But if something really bad happens, you don't really have a cushion with other stocks if you rely just on one sector. Another big thing to consider is the yield and how often a company raises its dividend and how much it does. So you definitely want to invest in a company that is raising its dividend each year. Like that is the thing I always look for. If a company has stayed stagnant with its dividend, it's typically something I'm staying away from, because if a company does not raise its dividend each year, that means it could struggle to pay that dividend, which could result in a dividend cut. So GameStop is an example here where they had a really high dividend. At some points, it was like 15%, some points even more than that. But they kept it at the same payout rate, like not rate, but they like same, like, 38 cents per quarter per share. They kept it for like a while at that rate, and now they slashed it. So you don't want that to happen to you if you're a dividend investor going for the dividend. Now, there are some dividend stocks where if they cut the dividend, it may still be a good buy, because if a stock says 38 cents per share and they say enough with the dividend, you'll get people to go away from the company because, some people are just attracted to it for the dividend. But that doesn't mean the company is any better or worse off because of that decision. There are a lot of things that happen in advance of a dividend cut that could indicate the company's in trouble. But at that moment of the dividend cut, the company isn't necessarily like a worse company. It's just a company that no longer offers dividends. And if you could stomach not having a dividend, if that's something that you're okay with as an investor, then those could be some opportunities sometimes. But with dividend cuts, you definitely want to be very careful, because usually it means they're in trouble or expenses are really mounting up. So you definitely want to think about, like, make sure the company's raising its dividend each year. And then are you after a high yield with very little like annual dividend growth rate, or are you after a company that maybe has a lower yield right now but has a higher growth rate? So an example, you could see like a 4% yield right now that gives you like 3 or 5% annual growth, or you could go into a 2% yield company that is giving you like 20 or 30% annual growth at that moment. Now, you can't expect the 20% growth to happen like every year forever. Like there are calculations, there are ways to like, what could your return look like in 30 years? If the company's growing at 20% annually now, in those calculations for like a 30-year return or whatever it is you want it to be, don't do the calculation of if this company continues to pay this 20% growth increase in the dividend year over year for 30 years, because the company can only increase the dividend if it's able to grow at a sustainable rate to warrant the dividend increasing at that same rate. So the reason that companies end up not being able to raise their dividend as high is because they have matured and it's harder for them to grow. Like, it's harder for a company with like $1 trillion cap to expand by 20% versus a company with maybe like $1 billion cap expand by 20. It's very different, because with the $1 billion scenario, you only have to have like $200 million. Now, as a company, like, I know these are really big numbers for people, but for companies, like, these aren't big numbers, especially if you think of like Amazon, like $200 million is like a rounding error. But anyway, for $1 billion company, you just need $200 million in extra market cap for a 20% increase. For a $1 trillion company, we're talking about $200 billion. So it's definitely a lot different. And then who are you going to keep tapping into for that money? So it definitely becomes like, you can't expect a company to keep growing 20% year over year forever, just because the company has to continue to grow at those kinds of rates to continue, not at 20% each year, but enough for payout ratio and different things like that. They have to continue to grow and tap into a new customer base to raise the dividend that high each time. So at your moment right now where you stand, do you go for the high yield play that doesn't necessarily give you as much of a annual dividend growth rate, or do you go for a stock that maybe could have higher appreciation, has like a higher growth rate for the dividend each year? Like that's a really big decision for you to make, because it's really the difference between you get like 5% annual now, like the yield, versus like a 2% yielder now that can turn into a 10% yield if you just give it a few years. For some people, maybe it's a decade. For some, even more. It just depends on how much the stock you pick raises its dividend each year. So that's one thing you want to consider. Another thing you want to consider is buying back shares. Like you have the dividends reinvestment program. And with the dividend reinvestment program, basically you get to buy some of the shares instead of taking the cash. So one of the things to think about, if you want to accumulate as many shares as possible, it makes more sense for you to pick a company that you don't see the prospects like shooting high up. Like you don't see the company, you don't see it falling apart. You definitely want to pick reliable companies, but you don't see it like soaring in value in a year, or like really staying at like a similar level. For you definitely want to see it go up a little bit, but it's not like you want to see massive gains in the price, because then that just lets you reinvest in more shares, which allows you to get more dividends each quarter. So those are some of the factors to consider when it comes to what is your criteria. And when you narrow this down based on, I want this type of yield, I want this type of annual growth rate, and I want it in these types of sectors, that's where you create a sophisticated investing strategy instead of just looking at the news, seeing this stock pop 20%, has a lot more room to run, and you follow the herd, you buy that stock, and then when it goes down, because stuff that goes up that much, it definitely goes down at some point due to correction, then you're selling with the herd as well. So you definitely want to invest like with a set plan. You don't want to just follow what other people are saying. You want to be able to consciously look at a stock, know what your decision is about it. And then, you know, if people say different things about it, the media says different things about it, new information comes out, you know how to act because you already have the preset determination of what is in your criteria. And by figuring out what is in your criteria, you also figure out what is not in your criteria. In some cases, you may expand a little bit beyond this criteria. I like to invest in stocks with at least a 3% yield. I'll trim that to like 2.5% if it means I'm getting a higher growth rate, or if I really like the company, or if I like the company and it's not in a sector that I feel at the moment that I am heavily invested in. Because again, you want to expand the sector so you don't get, you're not reliant on how well that sector does. So one way to diversify without doing a ton of research into sectors you really don't care about, just get index funds. That's pretty much all you really have to do with the SP 500. And that will help you diversify instead of having to know every single sector, every single, like, you know, for REITs, for instance, you really got to pay attention to interest rates and knowing things like that for every single sector. Instead, you just focus on the sectors you know. You have the index fund cover the sectors that you don't know much about, but you still want to invest in so that you're diversified. And that will help you create the dividend investing portfolio that if you give it time and you continue to nurture it each month by putting more of your money into it, not just the reinvestment, but more of your earned income, that is going to help you have the retirement eventually funded by dividend investing. So I do hope you guys enjoyed this video. Make sure you subscribe for more content just like this. My new book is recently out, which goes a lot deeper into how you can retire using dividend investing. Anyways, dream big, achieve greatness, unlock your potential today.